In the early hours of December 23, 2025, as financial markets in Asia opened to the day's trading, a report from the People's Bank of China confirmed a development that had been rumored for weeks. Beijing had executed a series of sales totaling approximately $400 billion in United States Treasury securities over the preceding 6 months, accelerating a divestment trend that began in earnest earlier in the year. This was not a frantic liquidation but a strategic reduction, rooted through offshore intermediaries and timed to minimize immediate market turbulence. Nonetheless, the impact was swift and severe. Yields on the benchmark 10-year US Treasury note surged past 5%, a level not seen since the inflationary spikes of 2022, as bond prices plummeted under the weight of increased supply. Borrowing costs for the American government, corporations, and consumers began to climb, threatening to stifle economic growth at a time when the United States was already grappling with a national debt exceeding $35 trillion. Analysts described the spike as potentially fatal to the fragile recovery, with mortgage rates jumping above 7% and corporate debt issuance grinding to a halt. This event, the latest chapter in the evolving economic rivalry between the world's two largest economies, exposed the vulnerabilities inherent in global financial interdependence. As we explore this profound shift, we will examine the historical foundations of China's investment in American debt, trace the methodical progression of the sell-off, uncover the subtler motivations and mechanisms at play, and assess the cascading consequences for economies around the world. To comprehend the magnitude of China's treasury dump, we must first understand the role of US Treasury securities in the international financial system. These are essentially IOUs issued by the United States government to fund its operations, from infrastructure projects to social programs and defense spending. They come in various maturities: short-term treasury bills that last a few months, medium-term notes spanning 2 to 10 years, and long-term bonds extending up to 30 years. Investors purchase them because they are considered among the safest assets available, backed by the full faith and credit of the U.S. government, which has never defaulted on its debt. In exchange, buyers receive regular interest payments, and the principal is repaid at maturity. The market for these securities is the largest and most liquid in the world, with daily trading volumes in the trillions of dollars. Prices and yields move in opposite directions. When demand is high, prices rise and yields fall, making it cheaper for the U.S. to borrow. Conversely, a flood of supply from sellers pushes prices down and yields up, increasing borrowing costs across the economy. China's involvement with U.S. Treasuries began in the late 1990s, coinciding with its economic takeoff. As the country shifted from a closed, centrally planned economy to a manufacturing powerhouse under reforms initiated by Deng Xiaoping in 1978, it accumulated vast foreign exchange reserves from export surpluses. Goods like electronics, textiles, and toys flooded global markets, particularly the United States, creating a trade imbalance where China earned far more dollars than it spent. To manage these reserves, preventing the renminbi from appreciating too rapidly and hurting exports, Beijing invested heavily in dollar-denominated assets, with U.S. Treasuries as the cornerstone. By 2008, China's holdings crossed the $500 billion mark, and they peaked at over $1.3 trillion in 2013. This made China the largest foreign holder of American debt for much of the 2010s, surpassing Japan at times. The relationship was mutually beneficial. China earned stable returns on its reserves while keeping its currency competitive, and the U.S. enjoyed low interest rates that fueled growth and consumer spending. However, this symbiosis carried inherent risks. For the United States, reliance on foreign buyers like China meant vulnerability to shifts in their investment strategies. Higher yields from sell-offs could raise the cost of servicing the national debt, which already consumes hundreds of billions in annual interest payments. For China, holding vast treasuries exposed it to dollar fluctuations and U.S. policy decisions, such as quantitative easing that devalued the assets through inflation. Tensions simmered through the 2010s, exacerbated by the US China trade war beginning in 2018, where tariffs targeted hundreds of billions in goods. China responded with modest reductions in holdings, dropping to around $1 trillion by 2020. The COVID-19 pandemic and subsequent supply chain disruptions further strained relations, but China's sales remained gradual, avoiding market panic that could harm its own portfolio value. By the early 2020s, broader forces pushed China toward diversification. Domestically, economic slowdowns from property crises and zero-COVID policies necessitated stimulus, prompting the People's Bank of China to repatriate funds for internal use. Internationally, the freezing of Russian assets in 2022 following the Ukraine invasion served as a wake-up call. Western nations could weaponize financial systems against adversaries. China accelerated purchases of gold, reaching over 2,200 tons by 2025, and boosted holdings in euros, yen, and commodities. BRICS initiatives expanded to include new members like Saudi Arabia and Iran, promoted trade in local currencies, reducing dollar needs. Holdings fell below $800 billion by mid-2024, with monthly reductions averaging $10 to $20 billion. Entering 2025, the pace quickened amid escalating frictions. Renewed U.S. tariffs on Chinese technology and EVs in January prompted retaliatory measures, including investigations into American agricultural exports. By March, China's holdings stood at $780 billion, down from $850 billion at year start. The sell-off gained momentum in April, as U.S. inflation data led the Federal Reserve to delay rate cuts, making treasuries less attractive. China sold $50 billion that month, routing through Belgian and Luxembourg custodians to obscure origins, a common tactic to prevent market overreaction. Let us now reconstruct the step-by-step progression of the $400 billion dump, based on available data and patterns observed in official reports. It unfolded in phases, aligned with economic cycles and policy announcements. Phase 1, from January to March 2025, saw initial reductions of $80 billion. This coincided with China's fiscal stimulus package, requiring dollar liquidation for renminbi injections. Sales focused on short-term bills, maturing quickly and allowing reinvestment in domestic bonds. Yields rose modestly from 3.8% to 4.1% on the 10-year note, attributed at the time to U.S. domestic factors. Phase 2, April to June, accelerated with $120 billion sold. U.S. sanctions on Chinese banks facilitating trade with Russia triggered this, as Beijing sought to reduce exposure to potential asset freezes. Long-term bonds were targeted, sold in blocks via offshore vehicles. The Treasury International Capital (TIC) data for May showed China's holdings at $700 billion, the lowest since 2010. Markets reacted. Yields spiked to 4.5%, prompting the Fed to intervene with repo operations to stabilize liquidity. The summer months July to September marked Phase 3, with $150 billion divested. This aligned with BRICS summits promoting a gold-backed settlement unit, freeing China to shift reserves. Sales were diversified, including notes to European buyers seeking alternatives to negative euro yields. By September, holdings dipped to $550 billion per TIC estimates. The yield surge hit 5%, crushing mortgage markets, rates exceeded 6.5% and stalling corporate bond issuances. The final phase, October to December, culminated in $80 billion sold, reaching the $400 billion total. Beijing's announcement on December 1 of further diversification formalized the move, citing strategic rebalancing. Yields pierced 5.2%, evoking memories of the 1994 bond market massacre. The U.S. government auctioned new debt at higher rates, adding billions to projected interest expenses. This sequence reveals hidden or less discussed factors driving the dump. One is the role of shadow banking. Chinese state-owned enterprises and provincial governments held treasuries off balance sheet, selling discreetly to avoid detection. Estimates suggest these accounted for 30% of the volume. Another is technological enablers. Algorithmic trading and blockchain platforms allowed precise execution, spreading sales across time zones to minimize price impact. Less visible is domestic politics. President Xi Jinping's push for self-reliance under dual circulation prioritized internal markets, viewing treasury holdings as a legacy vulnerability. Geopolitically, the dump aligned with de-dollarization alliances. China's yuan internationalization, through CIPS payment system, reduced dollar needs for trade with BRICS partners. Environmental considerations lurked. Rare earth exports, restricted in retaliation, linked to treasury sales as economic leverage. Cultural narratives in China framed it as reclaiming sovereignty from Western dominance. The global implications of this yield spike are vast and enduring. For the United States, higher borrowing crushes fiscal flexibility. Annual interest payments could exceed $1 trillion by 2027, forcing cuts in entitlements or defense. Consumer impacts are im. 88 auto loans at 8% slow sales, housing slumps with 7% mortgages. Corporations delay expansions, stifling job growth. Emerging markets suffer contagion. Dollar strength from rising yields crushes currencies, inflating debt burdens. India and Brazil face capital outflows, prompting rate hikes that dampen recovery. Europe, with its own debt woes, sees contagion. German bond yields rise in sympathy, straining the Eurozone. Asia benefits relatively. Japan, holding $1 trillion in treasuries, holds steady but diversifies. China's economy, buoyed by repatriated funds, invests in infrastructure, mitigating slowdowns. Commodity markets shift. Gold surges as a haven, hitting $3,000 per ounce. Oil, priced in dollars, becomes costlier for importers, exacerbating inflation. Humanitarian effects emerge. Higher U.S. rates slow aid flows as budgets tighten. Climate investments falter, renewable projects delay amid costly financing. In contemplating this treasury dump, we see a turning point in economic history. China's action, while self-serving, exposes the dollar system's fragility. For decades, foreign buyers subsidized U.S. profligacy. Now, the bill comes due. Yet adaptation offers hope. The U.S. could pursue deficit reduction, attracting buyers through fiscal prudence. China might stabilize sales to avoid mutual harm. Its own exports rely on American consumers. Globally, diversified reserves could emerge. A multipolar system with yuan, euro, and digital assets sharing the load. Dialogue through IMF or G20 might forge new norms. As yields stabilize and economies adjust, one lesson endures. Finance is geopolitics by other means. The dump reminds us that power flows through bonds as much as borders. Wisdom demands balance, where interdependence fosters prosperity, not peril. The future of American borrowing hangs in the balance, shaped by choices yet to be made. As markets absorb the confirmation of China's accelerated divestment in late December 2025, the U.S. Treasury market entered a period of sustained volatility that tested the resilience of institutional buyers and the Federal Reserve's toolkit. Auction results for new debt issuance in the final weeks of the year showed weakening demand. Bid-to-cover ratios, the measure of how many bids were received relative to the amount offered, fell below historical averages, forcing the Treasury to accept higher yields to place the full allotment. The 30-year bond auction on December 28, for instance, cleared at yields approaching 5.5%, a level that immediately transmitted to long-term borrowing rates across the economy. Corporations postponed bond offerings, with investment-grade issuance volumes dropping by over 50% compared to the previous quarter. Municipal bonds, used to finance local infrastructure, saw yields spike similarly, delaying projects from school construction to highway repairs. The stock market, sensitive to discount rates on future earnings, experienced sharp corrections, with the S&P 500 shedding nearly 10% from its November highs by year-end. Technology firms, reliant on cheap capital for growth investments, suffered the most, while value sectors like energy held up relatively better. The Federal Reserve, caught in a delicate position, convened an emergency meeting on December 26. Chairman Jerome Powell, in subsequent remarks, acknowledged the external pressures but emphasized domestic factors, inflation lingering above target and a robust labor market, as reasons for maintaining a restrictive stance. No immediate rate cuts were signaled, disappointing markets hoping for relief. Instead, the Fed expanded its balance sheet operations, purchasing treasuries in the secondary market to cap yield rises, but these interventions proved limited against the structural supply from foreign sellers. Analysts noted that with China's holdings now estimated below $400 billion, the lowest since 2009, the ongoing reduction removed a perennial source of demand that had kept yields suppressed for years. Within China, the proceeds from the sales were redeployed with deliberate focus. A significant portion bolstered domestic stimulus efforts. Local government financing vehicles received injections to complete infrastructure projects stalled by earlier debt crackdowns. The People's Bank of China channeled funds into targeted lending for high-tech manufacturing, aligning with national priorities in semiconductors, artificial intelligence, and renewable energy equipment. Gold purchases accelerated further, with official reserves approaching 2,500 tons by early 2026 estimates, reinforcing the metal's role as a non-dollar hedge. Investments in Belt and Road projects increased, particularly in Africa and Southeast Asia, where yuan-denominated loans replaced dollar financing, deepening economic ties and promoting renminbi usage in trade settlements. Let's discuss. The aspects of the divestment strategy revealed sophisticated execution. Much of the selling occurred through sovereign wealth funds and state-linked entities in third countries, obscuring direct attribution and allowing China to maintain plausible deniability regarding market impact. Derivative positions, interest rate swaps and futures, were used to hedge remaining holdings, protecting against further price declines while freeing capital. Coordination with other BRICS nations played a role. Russia and India quietly reduced treasury exposures in parallel, creating a collective signal without formal announcement. Domestic propaganda framed the move as prudent risk management, emphasizing protection against U.S. financial hegemony and potential sanctions similar to those imposed on Russia. The human and sectoral impacts within the United States began to materialize more concretely as the yield spike persisted. Homebuilders reported cancellations surging 20%, as potential buyers retreated from 7+% mortgage rates. Adjustable rate loans reset higher for existing borrowers, straining household budgets already pressured by lingering inflation in essentials like food and energy. Small businesses reliant on variable rate credit lines tied to Treasury benchmarks cut hiring plans, contributing to a slowdown in job growth reported in early 2026 labor data. Universities and hospitals, major issuers of tax-exempt debt, postponed expansions, affecting healthcare access and research funding in some regions. Corporate America adapted unevenly. Large multinationals with strong balance sheets tapped revolving credit facilities or issued short-term commercial paper at elevated but manageable rates, while highly leveraged firms faced refinancing walls. Private equity buyouts virtually halted, as debt financing became prohibitive. Energy transition projects, wind farms, solar installations, battery storage, saw delays, as project finance yields rendered many uneconomical without subsidies that Congress struggled to expand amid fiscal debates. Geopolitical ramifications extended the crisis's reach. Allies like Japan and the United Kingdom, major treasury holders themselves, faced internal pressures to follow suit but largely held firm, wary of destabilizing the system they benefited from. Taiwan and South Korea, with substantial reserves, quietly diversified into gold and agency bonds. Emerging markets, many dollar-indebted, suffered currency depreciations that inflated local borrowing costs, prompting IMF consultations for several nations. China's move emboldened discussions within BRICS about accelerated de-dollarization mechanisms. Pilot programs for cross-border settlements in national currencies expanded, with oil trades between Saudi Arabia and China increasingly invoiced in yuan. Digital currency initiatives gained traction. The ECNY saw wider adoption in international payments, challenging SWIFT's dominance in certain corridors. Environmental and resource markets felt indirect shocks. Higher U.S. rates slowed green investments globally, delaying climate mitigation efforts at a critical time. Commodity exporters like Australia and Canada benefited from stronger terms of trade as investors sought real assets, but volatility persisted. As the new year dawned with yields entrenched at elevated levels, policymakers on both sides of the Pacific grappled with the altered landscape. U.S. Treasury officials explored ways to broaden the buyer base, courting domestic pensions and retail investors through new products, while acknowledging the end of an era where foreign central banks absorbed unlimited supply. In Beijing, strategists weighed the benefits of continued pressure against risks of global slowdown impacting Chinese exports. The interplay of finance and power revealed itself starkly. A nation's debt, once a symbol of strength, now a point of leverage in great power competition. Markets adjusted day by day, with volatility measures remaining high and liquidity in longer maturities strained. Institutional adaptations emerged, hedge funds positioning for persistent high rates, insurers shifting durations, but the broader economy absorbed the pain gradually, sector by sector. Diplomatic channels, though strained, remained open. Back-channel discussions explored potential stabilization measures, phased sales in exchange for tariff relief or coordinated interventions to cap yields. Yet trust, eroded by years of friction, proved elusive. The crisis's trajectory into 2026 remained uncertain, shaped by upcoming Federal Reserve decisions, Chinese economic data, and unforeseen events. Borrowing costs, now structurally higher, reshaped investment priorities and household decisions across America. The Treasury market, long the bedrock of global finance, navigated uncharted waters, its depth tested by the withdrawal of its once steadfast supporter. As the calendar turned to 2026 and the yield spike showed few signs of abating, the structural consequences of China's Treasury divestment began to embed themselves more deeply into the fabric of the American economy. Corporate earnings reports for the fourth quarter of 2025, released in January and February, painted a picture of widespread margin compression. Higher interest expenses eroded profits for companies with significant floating rate debt, while those reliant on capital markets delayed or canceled expansion plans. The commercial real estate sector, already weakened by remote work trends, faced a wave of refinancings at rates double those of just 2 years prior, triggering defaults on office and retail properties in major cities. Banks, holding large portfolios of commercial mortgages, increased loss provisions, contributing to tighter lending standards that further constrained credit availability for small and medium enterprises. Consumer confidence indices, tracked by organizations like the Conference Board, registered sharp declines, as households grappled with resetting home equity lines of credit and elevated costs for durable goods financed through installment plans. The Federal Reserve's dilemma intensified, with inflation moderating but remaining above the 2% target, driven in part by imported goods becoming costlier amid a stronger dollar. The central bank faced criticism from both sides. Fiscal hawks in Congress demanded spending restraint to ease supply pressure on bonds, while progressive voices called for emergency rate cuts to alleviate borrowing pain. Powell's testimony before congressional committees in February acknowledged the external shock from foreign sales, but maintained that monetary policy must remain data-dependent, signaling no pivot until labor market weakening became evident. Behind the scenes, the Fed expanded its standing repo facility for foreign official institutions, subtly encouraging central banks to lend treasuries back into the market for dollars, but participation remained limited amid global uncertainty. In China, the reinvested proceeds fueled a multifaceted domestic agenda. Infrastructure spending surged in the first quarter of 2026, with high-speed rail extensions and urban renewal projects creating construction jobs and stimulating related industries like steel and cement. Technology sectors received targeted support. Subsidies for semiconductor fabrication plants and battery production helped narrow gaps with Western leaders, while electric vehicle incentives sustained consumer demand despite export headwinds. The renminbi, bolstered by capital controls and intervention, appreciated modestly against the dollar, aiding import affordability for commodities like oil and soybeans. State media portrayed these moves as evidence of resilient self-sufficiency, contrasting China's steady growth, projected at 5% for 2026, with Western stagnation. Less prominent but significant were the secondary financial maneuvers accompanying the dump. Chinese entities increased purchases of agency bonds, issued by government-sponsored enterprises like Fannie Mae and Freddie Mac, as a partial substitute, maintaining some dollar exposure while diversifying from direct treasuries. Gold exchange-traded funds backed by physical bullion saw inflows, with Shanghai exchanges reporting record volumes. Sovereign wealth funds, such as the China Investment Corporation, allocated to alternative assets, private equity in Southeast Asia, real estate in the Middle East, and stakes in commodity producers across Africa. These shifts, while reducing headline treasury holdings, preserved diversified dollar access through indirect channels. Geopolitical dimensions grew more pronounced. The divestment emboldened voices within BRICS calling for formalized alternatives. Discussions at preparatory meetings for the 2026 summit explored expanding the new development bank's lending capacity in member currencies. Saudi Arabia and the United Arab Emirates, new members, accelerated yuan-based oil sales to China, further eroding the petrodollar's exclusivity. European nations, holding substantial treasuries themselves, debated collective responses. France and Germany floated ideas for euro-denominated safe assets to attract Asian reserves, but coordination proved elusive amid internal EU fiscal debates. Within the United States, sectoral adaptations varied widely. Defense contractors, benefiting from bipartisan support for military spending, secured funding through dedicated appropriations less sensitive to market rates. Renewable energy projects, however, stalled. Developers of offshore wind farms postponed auctions, citing unviable economics at current financing costs. Universities endowed with bond-heavy portfolios faced endowment drawdowns, prompting tuition hikes or program cuts. State and local governments, many with pension obligations tied to fixed-income returns, confronted underfunding gaps that threatened public services. Consumer behavior shifted perceptibly. Auto sales slumped as financing rates for car loans crossed 9%, favoring used vehicles over new. Credit card delinquencies ticked upward, particularly among lower-income households carrying revolving balances. Retailers reported softer holiday spending extending into 2026, with discretionary categories like electronics and furniture hit hardest. International institutions monitored the spillovers closely. The International Monetary Fund, in its January update, revised global growth downward by 0.5%, citing U.S. borrowing stresses as a key factor. Emerging markets with dollar-denominated debt faced renewed crises. Several Latin American nations sought precautionary credit lines, while African borrowers contended with higher servicing costs amid commodity price volatility. Diplomatic efforts to address the underlying frictions gained tentative momentum. Quiet channels between Treasury officials and Chinese counterparts explored mutual de-escalation, phased tariff reductions in exchange for stabilized holdings. Yet progress remained slow, hampered by domestic politics on both sides. As the yield environment settled into a new, higher normal, financial innovation responded. Structured products offering inflation protection or floating rates gained popularity among investors. Domestic buyers, household savings through money market funds, corporate cash piles, stepped in partially, but not enough to fully offset foreign withdrawals. The Treasury market's evolution continued day by day, with each auction a test of depth and resolve. Liquidity in off-the-run securities thinned, widening bid-ask spreads and complicating hedging for institutions. Volatility indices for bonds remained elevated, signaling persistent uncertainty. Policymakers weighed longer-term reforms. Proposals for fiscal rules to cap deficits resurfaced, alongside ideas for sovereign wealth funds to recycle surpluses into treasuries. In China, debates on reserve management balanced risk reduction with export competitiveness, mindful of a slower global economy impacting demand. The interplay persisted, with markets pricing in scenarios from soft landing to recession, contingent on policy responses and external developments. Borrowing, once taken for granted as inexpensive, now carried a premium reflective of altered realities. The economy adjusted incrementally, sector by sector, household by household, as the full weight of the divestment's consequences unfolded. As spring 2026 approached, and the higher yield environment became the new baseline, the broader contours of the U.S. economy's adjustment to China's Treasury divestment grew increasingly visible in everyday indicators. Retail sales data for January and February showed subdued growth, with big-ticket items like appliances and furniture registering outright declines, as consumers deferred purchases amid elevated financing rates. The housing market, a traditional engine of wealth creation and economic activity, entered a prolonged stall. Existing home sales fell to levels not seen since the early 2010s, while new construction permits dropped sharply in response to builder caution over unsold inventory and higher mortgage costs. Inventory levels rose in many metropolitan areas, yet prices held relatively steady due to low supply from homeowners locked into sub-4% mortgages from prior years. This rate lock effect, as economists termed it, created a frozen market where neither buyers nor sellers moved freely, further dampening related industries like real estate services, home improvement, and moving companies. Corporate investment decisions reflected similar restraint. Capital expenditure announcements from major firms trended lower, with many citing the need to preserve cash in an uncertain rate environment. Technology companies, previously aggressive in research and development spending, scaled back ambitious projects in artificial intelligence infrastructure and cloud expansion, opting instead for efficiency measures and stock buybacks where cash flows permitted. The energy sector presented a mixed picture. Traditional oil and gas producers benefited from resilient commodity prices, but renewable developers struggled to secure project finance at viable returns, leading to cancellations of several utility-scale solar and battery storage initiatives scheduled for 2026 groundbreaking. The labor market, long a bright spot in the post-pandemic recovery, began to show cracks. Initial claims for unemployment insurance rose gradually through the first quarter, concentrated in interest-sensitive sectors such as construction, real estate, and durable goods manufacturing. Wage growth, while still positive, moderated as employers faced softer demand and higher borrowing costs for payroll expansion. Part-time and temporary employment increased relative to full-time positions, signaling caution among businesses. Regional disparities emerged, states with heavy exposure to housing and consumer discretionary spending. Florida, Texas, California experienced more pronounced slowdowns, while energy-producing regions like North Dakota and Oklahoma remained comparatively insulated. In Washington, fiscal policy debates intensified against this backdrop. The administration proposed infrastructure supplemental funding to offset private sector retrenchment, but congressional gridlock delayed passage amid concerns over adding to deficits already requiring higher interest payments. The debt ceiling, suspended through mid-2026, loomed as the next potential flashpoint, with rating agencies placing the U.S. sovereign outlook under review for possible downgrade if political brinkmanship recurred. Treasury issuance calendars expanded to accommodate larger quarterly refundings, testing market absorption capacity at prevailing elevated yields. Primary dealers, the banks obligated to bid at auctions, reported strained balance sheets from holding unsold inventory when end investor demand proved insufficient. China's internal economic management continued to prioritize stability amid global headwinds. Export growth slowed as higher U.S. borrowing costs curtailed American consumer spending on imported goods, prompting Beijing to deepen stimulus measures. Property sector support packages expanded in early 2026, with relaxed mortgage rules and direct purchases of unsold inventory by state entities aimed at stabilizing developer balance sheets. Consumption vouchers and tax rebates targeted middle-class households, seeking to offset export weakness through domestic demand. The People's Bank of China maintained accommodative liquidity conditions, ensuring interbank rates remained low despite global tightening trends elsewhere. Less observable but strategically significant were adjustments in China's reserve composition beyond headline treasury reductions. Allocations to supranational bonds, issued by institutions like the Asian Infrastructure Investment Bank and New Development Bank, increased, providing dollar exposure through multilateral channels less vulnerable to unilateral actions. Equity investments in strategic overseas assets, particularly in critical minerals and technology firms, grew quietly through state-guided funds. Currency swap lines with partner nations expanded, facilitating renminbi liquidity provision that reduced dollar borrowing needs for trade finance. International responses diversified. Central banks in surplus nations like Singapore and Norway maintained treasury holdings but hedged duration risk through derivatives. European institutions, facing their own yield pressures from ECB policy normalization, cautiously added to dollar assets seeking relative attractiveness. Private sector flows showed resilience. U.S. mutual funds and exchange-traded funds focusing on treasuries saw inflows from retail investors chasing higher yields, partially offsetting official sector outflows. Social impacts accumulated gradually. Retirement planning adjusted as bond-heavy portfolios delivered improved income, but at the cost of capital preservation concerns. Younger households delayed major life milestones, home purchases, family formation, exacerbating demographic trends already challenging long-term growth prospects. Educational institutions with endowment exposure recalibrated spending plans, affecting research grants and financial aid programs. Market technicians monitored technical indicators closely. The Treasury yield curve, inverted for much of the prior period, began to steepen as long-end rates rose faster than short-term, traditionally signaling growth expectations, but now interpreted through the lens of supply pressure. Volatility, while elevated, avoided the extremes of past crises, reflecting orderly if painful adjustment. Policy experimentation emerged on both sides. U.S. proposals for baby bond programs or expanded retail treasury direct accounts sought to cultivate domestic demand. Chinese discussions around further reserve transparency aimed to reassure markets of measured divestment pace. The trajectory into mid-2026 remained fluid, contingent on data flows and decision points. Inflation readings, employment reports, and corporate earnings seasons would inform Federal Reserve calculus, while Chinese economic indicators, property sales, manufacturing PMI, consumer sentiment, shaped stimulus calibration. Auction calendars and tick reports provided ongoing barometers of foreign participation. The financial system adapted incrementally, reallocating capital across sectors and borders in response to the new price signals. Institutions strengthened balance sheets against duration risk, households recalibrated budgets, and policymakers navigated competing imperatives of growth support and inflation control. The divestment's legacy unfolded not in dramatic rupture but in persistent reorientation, where higher borrowing costs became a defining feature of the economic landscape. Influencing decisions from corporate boardrooms to family kitchens. The interplay of national strategies and market forces continued to shape outcomes, with each data release and policy announcement adding layers to the evolving narrative.